Most people think of silver as a poor man's gold, a forgotten metal. But what if everyone has that wrong? What if the story we've been told is about to break? Forget everything you think you know about silver's price, because something strange is happening. The old rules aren't applying anymore. Honestly, have you looked at the charts lately? They're telling a different story. A story of pressure building for decades. We're not just talking about a little spike here. We're talking about a fundamental reset. So let's ask the real question. Is silver's cage finally about to open? Could it really reach $100? That number sounds impossible, right? It sounds like pure fantasy, but you need to understand why it doesn't. The market has a funny way of making the impossible reality. When no one is looking, when everyone is focused elsewhere, that's when the real moves happen. And right now, silver is quietly whispering. It's been whispering for a while, but almost nobody is listening. They're distracted by flashier trends, by digital assets and stock market drama. Meanwhile, this ancient metal just sits there, holding a secret, a very big one. Now look at the last 20 years. Every single attempt to contain silver has failed in the long run. It always pushes back. It's a metal with a history of rebellion. Think about this. What happens when an industrial necessity is also a form of money? You get a paradox, a ticking clock. Silver gets used up in factories and solar panels. It gets consumed. But it's also hoarded in vaults as a treasure. So which force wins? Is it a tool or a treasure? That's the tension we need to explore. And that tension is reaching a breaking point. You can feel it. The data is starting to scream. But the mainstream isn't reporting it. Not yet. Let's dig into why. Start with the basics. There are two silvers. The first is the industrial metal. It's in your phone, your car, and the solar panels on rooftops. We're using more of it every single year. And this isn't a small trend. The green energy revolution is built on it. But here's the catch. We aren't finding huge new deposits anymore. The easy silver has already been mined. So supply is getting tight. Honestly, how many new silver mines have you heard about? Exactly. The second silver is the monetary metal. This is the one people buy and hide. They put it in safes and bank vaults. They treat it like a secret insurance policy. And this demand comes in waves, usually during times of fear, when people stop trusting banks or governments. But what if both of these silvers are about to collide? What if industrial hunger meets monetary fear at the same time? That's the recipe for something explosive. You see, for years, these two demands took turns. One would be strong while the other slept. That kept things in balance, a kind of stable chaos. But look at the world now. Industrial demand isn't slowing down. In fact, it's accelerating. And monetary demand, it's starting to wake up. You can see it in the sales figures from mints around the world. They've been quietly setting records. So both engines are starting to fire simultaneously. Now consider the paper market. That's where the price is supposed to be set, in trading houses in London and New York. But there is a growing problem there, a disconnect. The amount of paper silver traded is enormous, but the amount of real physical silver is shrinking. What happens when people ask for the real thing? Not a promise on a screen, but bars they can hold. This is where the story gets interesting, and where our $100 question begins to make sense. Let's talk about that paper versus physical disconnect. It's the key to everything. You see, for decades, the market has run on paper contracts, promises to deliver silver someday. The system works fine, as long as no one asks for too much at once. But what if they do? The warehouses that hold the real metal are being drained, their stockpiles are falling. Look at the reported inventories in the major exchanges. They're not at zero, but the trend is clear. It's a slow, steady decline. Now, here's a direct question for you. If you owned one of those paper contracts, would you want the metal, or would you just want the cash? Most traders just want the cash. They never think about the physical stuff. But a growing number of people are choosing the metal. They're taking delivery. And that changes the game, because every bar that leaves a warehouse doesn't come back. It goes into a private vault, a safe, a hiding place. It disappears from the system. This creates a subtle strain, a pressure on the plumbing of the entire market. The people who run this system are clever. They can manage this pressure for a long time. But can they manage it forever? History says no. There's always a breaking point. We've seen it in other markets before, when the demand for the real thing overwhelms the paper promises. The price has to move. It has to find a new level, a level that brings balance back. And that new level could be much, much higher. Think about the last time you saw a true shortage of something. Remember what happened to the price. It didn't go up by 10%. It doubled or tripled or more. Because price is the only tool that rations scarcity. Silver isn't in a visible shortage yet, not on the surface, but the groundwork is being laid. Beneath the calm trading floors, the foundation is shifting. And the people who watch the physical metal are getting nervous. They're the canaries in the coal mine. And right now, those canaries are restless. So who are these canaries? They're not the big Wall Street banks. They're the refiners, the coin dealers, and the industrial buyers. The people who handle the metal every single day. They feel the pinch first. They see the delays in getting fresh supply. They notice the premiums they have to pay over the reported price. That premium is a silent alarm. It's the real price shouting over the official one. If the official price is $30, but you have to pay $35 to actually get a bar, what's the real price? It's $35. The market is telling you something, and that premium has been popping up more frequently. During moments of stress, it spikes. Then it settles back down, but never quite to where it was before. It's like a ratchet. Each event clicks it up one notch. And we've had a few events lately, haven't we? Look at the last few years of global uncertainty. Did that increase the desire to own something real? Of course it did. Now, let's add another layer. The investment world is changing. New funds allow people to buy silver as easily as a stock. These funds are supposed to hold real metal to back their shares, and billions of dollars have flowed into them. That's billions of dollars bidding for a finite amount of physical bars. This creates a direct link. Money from a screen gets converted into a demand for a physical object. It turns digital dollars into hard metal. And these funds don't sell the metal when the price dips. They just hold it. They're like sponges, soaking up supply and locking it away. This is a modern twist on an old story. It's a new kind of demand that didn't exist 20 years ago. It's structural. And it's not going away. Put all this together. Tightening mine supply, soaring industrial use, a growing pile of metal locked in funds, and a nervous group of people taking delivery. You start to see the shape of the box, Pandora's box. Because once this combination gets going, it's hard to stop. The lid doesn't close easily. But let's pause for a second. $100 is a specific number. Why throw it out there? It's not a random guess. You have to look at history for context. Adjusted for inflation, silver's all-time high isn't what you think. In today's money, the 1980 peak was well over $100. Some calculations put it much higher. So the market has been there before. It's not uncharted territory. The psychological barrier is ours, not the market's. Now, consider the ratio, the gold to silver ratio. Traders have watched this for centuries. It's simply how many ounces of silver it takes to buy 1 ounce of gold. Historically, that number sat around 15 or 16 to 1. For most of modern history, it's been much higher, between 50 and 80 to 1. Right now, it's hovering in that high range. What if that ratio just moved back to its historical average? Not even to the ancient level, just to, say, 30 to 1. If gold stays where it is, or goes higher, the math for silver becomes explosive. The catch-up move would be enormous. This isn't speculation. It's simple arithmetic. And markets have a habit of reverting to their means. Eventually. The question is always timing. What could be the trigger? It might not be one single event. It could be a series of smaller cracks, a major mine closure, a sudden surge in central bank buying of gold, which often spills over, or a failure to deliver on one of those paper contracts we talked about, a single credible report that a major exchange can't provide the metal. That's the kind of spark that lights a fuse, because trust is the glue of the paper market. Once that glue weakens, everything changes fast. People don't wait around to see if it's true. They just act. They buy whatever they can get. And that's how a shortage is born, not from an actual lack of metal in the earth, but from a panic to secure it before someone else does. We've seen this movie in other commodities. It always ends the same way, with a price that no one thought possible, until it was reality. Let's talk about this potential trigger in plain terms. Imagine you're a large manufacturer. You need silver to make your product every single week. Your entire assembly line depends on it. You hear rumors of delays. You see your usual supplier getting nervous. What do? You don't wait for the official price to move. You go out and you secure your supply. You pay a little more to guarantee you get it. Now multiply that by every manufacturer in the world. That's a wave of buying that isn't based on speculation. It's based on survival. Pure necessity. That's the industrial demand side waking up in a panic. Now, on the other side, picture an investor. They see the manufacturer scrambling. They read the headlines about delivery problems. Their instinct isn't to sell, it's to buy more. To get in before it becomes a mainstream news story, so both sides start pulling on the same rope, hard. The manufacturer and the investor aren't enemies. They're competitors for the same fixed amount of metal. This is the squeeze that theorists talk about. And it's not a fantasy. It's a logical outcome of the setup we see today. All it needs is a push. A legitimate reason for fear to override complacency. We've been in a period of complacency for a long time. People believe the system will always provide. But systems are fragile. We've learnt that over and over. So what breaks the complacency? Maybe it's a geopolitical event that disrupts a major refining hub. Maybe it's a sovereign nation deciding to stockpile silver for strategic reasons. China, for instance, doesn't talk about its silver reserves much. What if their industrial appetite suddenly includes a monetary stockpile? The point is, the triggers are out there. They're lurking. The market is a complex machine, and right now, a lot of gears are moving into alignment. For silver, the path of least resistance might not be sideways anymore. It might be up, steeply up. And that's where our $100 target stops being a silly dream. It becomes a simple function of pressure and release, a valve finally blowing off. Now let's address the biggest counter-argument, the mountain of so-called above-ground silver. People will tell you there are billions of ounces in vaults already, that this will satisfy any demand. And it's true, there's a lot of silver sitting in London and New York. But who owns it? And is it truly for sale? A huge portion is already claimed. It's held by those exchange-traded funds we mentioned. It's in sovereign vaults, or it's part of strategic industrial stockpiles. This isn't silver waiting for a buyer. It's silver that's already spoken for. It's off the market. The available float, the amount that actually trades, is much smaller. Think of it like a house in a neighborhood. Just because there are 100 houses doesn't mean they're all for sale. Maybe only 2 or 3 are on the market at any time. That sets the price. If 10 families suddenly want to move into that neighborhood, a bidding war starts. The price of those 2 houses soars. It doesn't matter that 100 houses exist. What matters is what's actually for sale. The silver market works the same way. The visible inventory is not the same as the available inventory. And available inventory is getting tighter. Then there's another factor. Silver is often produced as a byproduct of mining copper, lead, and zinc. If the price of those metals falls, those mines can cut production. That means less silver comes out of the ground. Even if silver's price is rising, the supply becomes less responsive. It can't quickly ramp up to meet new demand. This creates a lag. And in markets, lag means volatility. Prices have to swing wildly to try and balance things. So the next time someone says there's plenty of silver, ask them this. Plenty for whom? At what price? Because that's the only question that matters. The market is auction. And right now, more bidders are showing up, with deeper pockets and more urgent needs. The old auctioneer might not be ready for that. Let's look at the bidders themselves. Who are they? First, you have the governments. They're quiet, but they're paying attention. India, for example, imports massive amounts of silver, not just for jewelry, but as a store of wealth for millions of people. Then look at the technology sector. It's not just one company. It's every company making electric vehicles, 5G infrastructure, and new solar farms. Their demand is written into their future plans. It's a forecast, not a guess. They've committed to these technologies. And these technologies commit them to silver. There's no substitute that does everything silver does. Not at the same scale, not at the same cost. So their demand is what economists call inelastic. They have to buy it, almost regardless of price. Because stopping production is more expensive than paying more for silver. That's a powerful kind of buyer. Then there's the retail investor, you and me. When the fear of currency debasement sets in, people turn to real things. They buy what they can afford. And silver is the affordable precious metal. It's the gateway. A wave of retail buying can drain the physical market for small bars and coins in weeks. We've seen it happen before. It creates a frenzy that feeds on itself. Empty dealer shelves make headlines. Headlines drive more fear. More fear drives more buying. It's a feedback loop. And we're potentially one major economic scare away from that loop starting. So you have these 3 forces lining up. Government stocking up, industry locked in, and the public waiting for a signal. They're not coordinated. They don't have a plan. But their interests are about to align. They'll all be reaching for the same thing at the same time. And in that moment, the paper price on a screen becomes irrelevant. It's just a number. The real price is what someone will pay to get the last bar on the truck. That's the moment the box opens. That's when Pandora's myth becomes our reality. Not as a curse, but as a simple market truth. Hidden things get revealed, and the true price is one of them. So, is this guaranteed? No, nothing ever is. Markets can stay irrational longer than you can stay solvent, as the old saying goes. The pressure could leak out slowly, new technologies could eventually find a substitute, or a deep recession could temporarily crush industrial demand. These are real possibilities. But here's the other side of that coin. What if the pressure doesn't leak? What if it builds? Because the trends pushing for it are long-term and structural. The green energy transition isn't a stock market fad. It's a global policy. The move towards onshoring supply chains isn't going away. That means more manufacturing, which needs more silver. And the distrust in financial systems? That seems to be growing, not shrinking. These aren't short-term trends. They're the currents shaping the next decade. So the question changes. It's no longer, could silver hit $100? It becomes, what happens if it does? What does that world look like? First, it would be a signal, a flashing red light for the entire commodity complex. It would mean the era of cheap, abundant raw materials is truly over. It would trigger inflation fears in a way gold alone never could, because silver is industrial. Its price is woven into the cost of everyday technology. A soaring silver price would ripple through supply chains. It would force difficult choices, substitution, redesign, cost-cutting. But most of all, it would be a wealth transfer, a massive one. From those who held no real assets to those who held even a little silver. It would validate the fears of the prepared, and it would shock the complacent. That's the real power of this story. It's not just a chart prediction. It's a story about changing values, about what we consider solid ground in a shifting world. Silver, sitting at $100, changes perceptions. It makes the impossible seem possible again, and that in itself is a kind of trigger for the next move and the next. Let's bring this down to earth. What should you do with this information? First, don't panic. This isn't a call to action. It's a framework for understanding. Watch the physical market, not just the ticker. Watch those premiums we talked about. Are they rising steadily? Watch the inventory reports from the major exchanges. Is the decline continuing? Listen to the earnings calls from industrial companies. Are they mentioning supply chain stress for raw materials? These are your signals. They're more honest than any analyst's price target. Second, understand the difference between paper and physical. If you believe this story, you have to decide which one you want. A paper claim can be a trading vehicle. But physical metal is a different kind of bet. It's a bet on the system itself straining. There are two separate games, played by different rules. Now, a direct question for you. When you look at the world today, does it feel like it's getting more stable or less? Your answer to that tells you everything about the potential for monetary demand, because people don't buy silver when they're confident. They buy it when they're not. And look around. Confidence seems to be in short supply. That's the fertile ground for this story to grow. But remember, timing is the great unknown. This could unfold over months, or it could take years. Markets move in sudden jumps after long periods of quiet. The quiet is the preparation. The jump is the event. We might be in the quiet period right now, where everything seems normal on the surface, but the ingredients are all on the table, measured and waiting. That's the essence of Pandora's box. It's not about the moment of opening. It's about everything that had to happen to make that moment possible. All the choices, all the pressures, sealed inside, until the lid can't hold any longer. So, where does that leave us? With a simple conclusion. The conditions for a historic move in silver are present. They are documented, measurable, and real. Whether that move actually happens is a matter of catalyst and time, but the potential itself is not a myth. It's a mathematical possibility, growing more likely. Look at the debt levels of nations. Look at the pace of money printing over the last decade. Historically, that's been rocket fuel for hard assets. Silver just hasn't caught that fuel yet. It's been dampened by the paper market's efficiency. But efficiency has its limits. We may be approaching those limits. Think about it this way. If you were designing a pressure cooker, you'd include a safety valve. The paper-silver market has been that valve, letting off steam to keep the pressure manageable. But what if the heat underneath keeps rising? What if the source of the heat won't turn off? Eventually, the valve itself can fail, or the pressure simply overwhelms it. That's the phase change we're watching for, not a gradual increase. A leap from one state of being to another, from a commodity to a monetary crisis, or perhaps a hybrid of both. That's when the charts break. That's when the models used by big banks stop working, because they're based on the old rules, the rules of the closed box, the rules before the lid started to rattle. And that rattling sound, it's getting louder. You can choose to ignore it. Many will, or you can choose to listen, to understand what it might mean. Not for getting rich quick, but for understanding how the world of value is being remade, right in front of us, in real time. Let's talk about what a remade world looks like. If silver reasserts its monetary role at a much higher price, everything shifts. Central banks, which mostly ignore silver now, would have to look at it. They manage reserves of gold and foreign currency. What if silver forced its way back into that conversation? It would complicate their models. It would introduce a volatile, unpredictable element. For the mining industry, a $100 price would be an earthquake. Exploration budgets would explode. Old mines considered dead would be re-examined overnight. But here's the catch. You can't turn on a new silver mine like a faucet. It takes a decade or more, so the supply response would be slow, painfully slow. And in that gap, the price could do incredible things. It could overshoot, way beyond $100. Markets are terrible at moderation when scarcity is real. They swing from indifference to panic. There's no middle ground. Now, consider the opposite force. What could keep the lid on? Technology could finally find a replacement, a material that does what silver does, but cheaper. Scientists are always working on that. But so far, nothing matches its unique combination of properties, not across all its uses. Governments could also intervene. They could release strategic stockpiles to cap the price. But do they have large silver stockpiles? Not like they have with oil. This isn't a weapon they likely have in their arsenal. The most likely dampener is simply a severe global recession, one that crushes industrial activity. That would hit demand, hard. But even then, would it kill the monetary demand? History suggests not. In fact, monetary demand often increases during a crisis, so the two forces might offset, leaving silver in a strange, volatile standoff. But standoffs don't last forever. Something breaks the tie. Our original question still stands. Is silver poised to break? All the evidence says the forces for a break are stronger than they've been in generations. The box isn't just rattling, its hinges are starting to strain. Let's examine those hinges. The first hinge is trust. Trust in the system that says a paper contract equals real metal. That trust is absolute until it isn't. We've seen fractures before. Small delivery delays, unexplained spikes in leasing rates. These are the creaks and groans. They're warning signs that the mechanism is under stress. The second hinge is scarcity, real physical scarcity. Not in the Earth's crust, but in the warehouses available to the market. When the line between in stock and not available blurs, psychology changes. Buyers stop buying for investment. They start buying for security. That's a different, more urgent kind of demand. The third hinge is time. Markets can ignore a problem for a very long time, but time also runs out for solutions. Every year of rising industrial demand without a major new mine is a year closer to a cliff. We're burning through the buffer. The cushion is getting thin. Now, you might be thinking, what about recycling? Won't that save us? It helps, but it's not a solution. Recycled silver comes from old electronics, jewelry, and industrial scrap. It's a steady trickle, not a gusher. And it's expensive to collect and refine. Higher prices will bring more to market, yes. But it's a slow, inefficient process. You can't plug a sudden hole. So the hinges rely on a delicate balance. Trust, scarcity, and time. Disturb one, and the others feel the strain. Disturb all three at once, and the door blows open. We're in a period where all three are being disturbed, slowly, steadily, by forces bigger than any trader or any bank, by the march of technology and the whims of geopolitics. This isn't a conspiracy, it's a convergence, a perfect storm of factors lining up. And in a storm, you don't ask if the wind will blow, you ask how strong it will get. That's the only question left. How strong could it get? Let's be brutally realistic. If the break happens, it won't be orderly, it will be chaotic. The price on your screen could freeze, or it could gap up dozens of dollars in a single session. This has happened in smaller, isolated markets. When the physical and paper worlds divorce, the charts break. Trading might be halted. The news would be confusing, full of conflicting reports. In that chaos, the true price will be set in back rooms and private deals, not on an exchange. That's when you'll see the real number, and it could be shocking. Now, this isn't a prediction of doom. It's a scenario based on market mechanics. It's the logical endpoint of a system that relies on a fiction. The fiction that paper is as good as metal. In normal times, that fiction holds. But these might not be normal times much longer. We're at the end of a long financial cycle. Debt is saturated. Currencies are being tested. In such eras, old truths resurface. One of those truths is that some things have value simply because they're real and scarce and useful. Silver checks every box, so is it poised to break $100? The setup is there. The pressure is there. The only missing piece is the catalyst, the spark. And sparks are, well, by their nature, unpredictable. You can't schedule them. You can only prepare for their possibility. That's the real takeaway here. Not a price target, but an understanding of fragility. The fragility of the system we take for granted, and the solidity of the things we've forgotten. Pandora's box is a story about curiosity, but it's also a story about what was left inside after all the troubles escaped. Hope remained. In this case, hope isn't an emotion. It's a physical object, with a melting point and a conductivity rating, waiting in the dark. This waiting game defines the market right now, a standoff between instant digital claims and ancient physical value. But history doesn't favor the digital in the long run, not when it comes to tangible things you can hold. Every paper promise ultimately relies on trust, and trust is a renewable resource until it isn't. So watch the trust indicators, watch the actions of the largest, smartest players. Are the mints running out of blanks to make coins? Are refiners quoting delivery dates weeks or months out? These are the signs that professionals watch. They don't wait for the news. They feel the supply chain tighten. They're the first to know. Now, consider the sheer scale of the financial system. Trillions of dollars looking for a home, a safe home. If just a fraction of 1% of that money decided silver was that home, what would happen? The math is staggering. It would overwhelm the existing market structure completely. That tiny fraction is a tidal wave in the silver pond. This isn't about millions of dollars moving. It's about billions looking for an exit from paper promises. Silver's market is small. That's its weakness in calm times, and its explosive potential in volatile ones. It's a pinpoint on the financial map, easy to ignore until it becomes the epicenter. We may be nearing the point where it's too small to do its job, too small to absorb the fear and the capital looking for refuge. When an asset is too small for the demand, it doesn't just rise in price, it shatters expectations. It rewrites the textbooks. That's the final stage of this process. Not a boom, but a repricing of reality, where the old anchors of value are dragged into new depths. Silver at $100 isn't the end of that story. It's just the first, most visible sign. A signal flare showing where the old world ended and a new, uncertain one began. So where does this leave us as we close? We followed the trail from industrial necessity to monetary fear, from paper promises to physical strain. The evidence isn't a guarantee, but it's a compelling map. A map to a place where prices aren't set by algorithms alone, but by desperation and need. The question of $100 silver transforms. It stops being a wild prediction and starts being a measuring stick, a way to gauge the health of the system itself. If silver stays suppressed, it suggests the old mechanisms still hold. The box is sealed tight, but if it breaks free, it tells a different story. A story of fracture, of a world valuing concrete things over abstract promises. You don't have to be an investor to care about that story. You just have to be a person living in this world, because that shift, if it comes, changes everything. From the cost of the technology in your hand to the stability of the currency in your account. The final truth is this: markets are stories before they are numbers. And the story of silver is being rewritten right now. Not by analysts on TV, but by the silent actions of refiners, manufacturers, and individuals taking delivery. They are writing it with their choices. The rest of us are just waiting to read it. The last chapter isn't written, but the plot is clear. Pressure builds, containment weakens. And then, one day, it doesn't. That's not a forecast. It's physics, applied to markets. So keep one eye on the charts, yes, but keep the other on the world outside your window. Watch for the signs of strain. Listen for the rattling of the lid. Because the answer to our original question won't come from a screen. It will come from the quiet, moment-by-moment choices that precede the storm. The story of Pandora's box ends with hope left inside. In our story, hope is simply the recognition of what's real. And what's real might be poised for a great and final escape.